And welcome back. It's great to have you.
Thanks, Carl.
We've been having a lot of conversations about how short selling is different when it comes to the banks. And we've been through this in prior, decades where there was discussion about a moratorium and then it finally came. Do you think one eventually will come this time?
I don't know that I'm the right person to guess on that particular point. I do think it's good that there's a discussion going on inside Washington, right inside the Beltway, about the impact that short sellers are having on so many banks. In our particular case, short interest as a percentage of float is the lowest among all the regionals, so it hasn't been a big pressure point for us. But I did hear the things that you all shared this morning about the impact that short selling is having on the regional bank indices, and of course we see it in some of the individual names.
The Street's really wrestling with the spread between sentiment and fundamentals. Can you characterize, at least from where you sit, where deposit betas are or what flow activity is like, and does it match with at least the price action we've seen last couple of days?
Yeah, no, it definitely doesn't match with the price action that we've seen the last couple of days. I will tell you, I think in my entire career, I have never been more excited to file quarterly earnings than I was a few weeks ago when we filed them, because it gave us the opportunity to show investors and our customers what was going on inside the regionals as a sector, and Fifth Third in particular. I think we are the only one of the large cap financial institutions who's actually grown deposits from June 30th last year, after the Fed really got going, through the end of the first quarter. And quarter over quarter, we were stable. January 1 to March 31, we were stable in terms of deposit balances. And then from Silicon Valley's failure to March 31, deposit balances were stable here. And that trend has continued. And we do expect to be stable or even to grow modestly between now and the end of the year.
Tim, curious if you've been thinking differently in terms of risk mitigation where the investment portfolio is concerned. And also, just as importantly, maybe even more importantly, has everything we've seen in recent weeks changed or shifted the way you're thinking about lending and credit conditions?
Yeah. So the time to make decisions on lending was last year, and we were fairly vocal about the fact that we thought there was more uncertainty in the outlook than either the forward curves reflected or that you were hearing discussed. And the byproduct of that is we did take some actions, call it the end of the first quarter, beginning of the second quarter last year, and our loan growth slowed materially. In fact, we came into this year with, I think, the lowest expectation in terms of our guidance on total loan growth. And the growth we are generating right now really is a byproduct of our dividend finance business and then our Provide medical practice finance business. So the actions that we were going to take, we did take last year. They're in the run rate in terms of our new originations. As it relates to the securities portfolio, we are a little bit different than the way that I think a lot of other folks manage their portfolio. We believe that options have value, and the byproduct of that is we hold over 99% of our entire securities book available for sale. And the byproduct of that, obviously, from an investor's perspective, is that you get real transparency into the total AOCI mark there. And I think that served us well in an environment, Carl, as you said, where the market's trading as much on narratives as it is on fundamentals.